Hey guys, in this video, I'm going to be sharing 4 expensive index fund mistakes that you need to avoid. Index funds are super convenient and easy to understand for the average person, but that doesn't mean you can't make serious mistakes with them. And so I hope you find these tips valuable and it helps you become a better index fund investor. The 4 mistakes that I'm going to cover in this video are first, choosing the wrong index funds. And I'm going to walk you through some examples of poor index fund choices so you know what to look out for. The second mistake I'm going to cover in this is choosing index funds with really bad expense ratios, and I'm going to show you exactly how costly this is. The third mistake is trying to time the market, and I'll show you how costly it is to be waiting around on the sidelines. And the fourth mistake that I'm going to cover is not staying invested for the long term, and I'll make sure that you're clear on what the journey entails when you hop on the index fund bandwagon. It's a bumpy ride, but the destination is worth it. I've added the timestamps for each section below, so feel free to jump around to whatever section is the most interesting to you. And also, these are the 4 that I thought were the biggest ones, but definitely share in the comments below if you think there's anything that I missed. Before we kick off with the first mistake though, I want to preface this by clarifying what I'm referring to as index funds. In the context of this video, I'm referring to low-cost, diversified index funds and ETFs that track a broad benchmark like the S&P 500 or a total stock market index. The kind of index funds that Warren Buffett recommends for the average investor. If you're just starting to invest or are new to index funds, be sure to check out these other videos to help you get caught up. I talk about some of the best index funds that you can own, some of the cheapest funds that you can get started in. I also talk about what to know about index funds when the markets are at record highs these days. And also I talk about some bad index funds that you should really avoid because they're just bad. So be sure to check those out. I link them down in the description. The first mistake that you need to avoid is buying the wrong index fund. Not all index funds are the same. You need to know what type of index fund you're investing in and what index is tracking, because there are many and not all are as broad and as diversified as you should expect. For example, I'm a huge fan of VFIAX, which is the Vanguard 500 index fund. And if you're not familiar with this fund, I create a video that does a deep dive into it, so be sure to check it out. But essentially, it is a low-cost diversified index fund that tracks the S&P 500, which means it basically owns the stocks of 500 large companies across virtually every sector of the US economy, like technology, healthcare, utilities, financials, etc. However, Vanguard has another index fund with a ticker symbol VFAIX, and this is completely different. This is a Vanguard Financials Index Fund, which comprises about 415 companies that are exclusively in the financial sector. So we're talking about only consumer banks, investment banks, mortgage REITs, reinsurance companies, insurance companies, stuff like that. VFAIX is a classic sector-specific index fund and can be confused with VFIAX, and is not meant to be a core part of your investment portfolio. Vanguard even says it themselves. An investor should expect high volatility from the fund, which should be considered only as a small portion of an already well-diversified portfolio. Looking at one more index fund, we have here VGSLX, which is another sector-specific index fund. But in addition to the problem of it being concentrated in a single sector, it only holds 181 companies, which isn't very high. Having too few companies in your index fund exposes you to greater volatility and the risk of big losses. There's nothing necessarily wrong with these sector-specific index funds, and the comparison with VFIAX was to get my point across that you need to be aware of what kind of index fund you're buying into. The majority of your investments should be in a low-cost, diversified, broad index fund. Once that is solid, then consider adding these other index funds if you think there are opportunities there. The second mistake that you want to avoid is buying index funds with high expense ratios. Do not assume that all index funds are low cost. High expense ratios and other fees are a drag on your rate of return, and you want to get out of those as soon as possible. This chart shows the growth of $10,000 invested into VFIAX over a 10-year time period. If you had kept your investment in VFIAX over that time, you would have ended up with just over $36,000 by October 2020. Here's another S&P 500 index fund with the ticker symbol SXPCX. It invests in the same thing as VFIAX, but the return is lower. With SXPCX, you would have $4,000 less than if you had invested with VFIEX. Adding one more S&P 500 index fund, and this is the ticker symbol RYSYX. With this, you would end up with $8,000 less than VFIEX. It invests in the same thing, but with even lower return. And the reason for the lower returns has to do with the expense ratio. VFIEX has an expense ratio of 0.04%, which is one of the lowest for an S&P 500 index fund. SXPCX is 1.29%, RYSYX is 2.43%. So just by choosing the more expensive fund, you could be losing a lot of money in the long run. Even though the expense ratio seems so small, the difference compounds over time and it grows exponentially. So the sooner you can get out of these high cost index funds, the more money you're gonna save. So if you're interested in learning more about these and other high cost index funds to avoid, be sure to check out this video right here. One more thing related to cost, make sure you're familiar with what your brokerage charges you in terms of load fees or sales charges or any of those other confusing fees. Every company is different and you need to make sure you know what you're paying. I found this guide published by the SEC to be very informative in helping me understand what the fees are. So I'll link it down in the description below and I hope you find it really helpful too. If you're just starting out, I highly recommend taking a look at a Vanguard account. I find that their cost structure is a lot more friendly to investors compared to other places. So you can check out their fees down in the description below. I have a link down there. And I have no affiliation with Vanguard, by the way. I just like their funds and I really like their transparency. The third mistake that you need to avoid is trying to time the market. If you're just starting to invest, there's a temptation to hold off on investing until the market comes down to a better price point. Especially if the market is at a record high, you might think it's a mistake to jump into investing and would prefer to just wait it out. I posted this video recently that gave you an estimate about how much you can expect to lose if you invested at absolutely the worst possible time. And I think it will help you understand and put into perspective what you can expect if you want to invest but are getting cold feet because the markets are at an all-time high. But if you're waiting on the sidelines to jump into the market at a better price, then I think there's two problems with that. It is really hard to time the market accurately if it ever does drop to a price attractive enough for you. And price swings in your favor aren't guaranteed no matter how long you wait. And the longer you wait, the more you miss out on the long-term growth potential of your money. The long-term growth potential is what you would call the opportunity cost of not being invested in the stock market. It's the benefit that you could have gotten but didn't get because you chose this different opportunity, which was choosing not to invest. Instead, maybe you stashed the money in a savings account, or maybe you went out and bought a new iPhone or a new car. The reality is, waiting to invest makes it so much more costlier to catch up down the road. Let's say, for instance, you want to save $1 million by age 67. If you start investing at age 20, you only need to invest $319 per month to get that goal. It jumps to $613 if you would start at age 30, $1,240 by age 40, and $2,831 by age 50. These numbers assume you have zero savings to start and a conservative 6% rate of return. At each age, the total amount you need to contribute as a share of your $1 million increases by a lot the longer you wait to start investing, from less than 20% at age 20 to almost 60% at age 50. By starting early, you give your money more time to grow so that you don't have to contribute as much. So in summary, don't try to time the market. Instead, I highly recommend you start investing consistently in small amounts with whatever little you can contribute. And this video on buying index funds when the markets are at record high explains a little bit more in detail on how that would work. So be sure to check it out. I will link it down in the description. The fourth mistake that you should avoid is investing in an index fund for just a short term. Buying into and selling out of an index fund over the course of a few months or a few years, it could be costly. But let's first start with some of the reasons why you would do it in the first place and then consider what the best course of action is. The first reason why you might consider selling your index funds is because the market is high and you're going to try to sell out before the market drops. And again, I would encourage you to try not to time the market. You just don't know which way the market is going to go in the short term. And chances are the market is going to be up in any given year. In the 90 years between 1928 to 2017, the S&P 500 saw gains 61 of those years and losses for 29 of them. So definitely the odds are in favor of going up. The second reason why you might consider selling your index funds prematurely is if the market tanked 10%, 20%, 30%, and you just can't handle the losses and you want to call it quits. I mean, yeah, the stock market can be a roller coaster and it can get scary at times when you see huge losses in your account. However, the best chances of you getting your money back is by staying in the market. It is the surest way to recover your money, but it is going to take time. And not only will the market eventually recover, but the longer you stay in the market, the gains that you receive are pretty much guaranteed based on the historical data. This chart is showing you the average annual return you would get investing in the S&P 500 for every 10-year rolling period. This one shows you the return for every rolling 20-year period, and you can see that all periods have positive returns. Here's the 30-year period returns, and here's the 40-year period returns. The data is clear that you're going to do really well the longer you are staying invested. The third and probably the only legitimate reason that you would consider selling index funds is because you have an opportunity to invest the money outside of the stock market for better returns. So maybe you have a great business idea that you want to put the capital into to get it started, or maybe you want to pay for grad school or schooling to increase your earnings potential, or maybe you found a great real estate deal that you want to put your money into. If you enjoyed this video, be sure to hit that like button down below, and don't forget to subscribe and hit that notification bell so you don't miss out on any future videos. Thanks for watching, and I'll see you guys next time.